Welcome back to Gold Rush Reporter, your go-to channel for honest, clear, and up-to-date analysis on gold and silver markets. I'm your analyst, and today we're digging into a question that's been on everyone's mind. Is gold and silver manipulation still happening, or is it finally fading away? If you're serious about protecting and growing your wealth in precious metals, stick with me. You'll want to hear this. And don't forget to hit the subscribe button and ring that bell so you never miss an update. For decades, speculation about manipulation in the gold and silver markets has persisted. People have been saying, the big banks are keeping prices low. But what's actually happening now? Recently, the chatter around silver manipulation has increased because, unlike gold, silver is a smaller market. That makes it theoretically easier to influence. However, silver's price also reacts heavily to industrial demand and production costs, forces that gold doesn't face as much. So, what does this mean for everyday stackers? Simply put, supply and demand are still the primary drivers. Despite the rumors of manipulation, we haven't seen any strong evidence that it's actively suppressing prices recently. Instead, the market seems to be moving naturally. But the question remains, could manipulation actually be pushing prices up instead of down? Before we go deeper, a quick shout out to Summit Metals. If you're looking to buy or sell gold and silver safely, summitmetals.com is a trusted option. Keep that in mind if you're actively trading or stacking. Now let's break down the recent movements. Several factors have contributed to small pullbacks in prices, like shifts in opinions about the December Fed rate cut, the dollar strengthening, and the reopening of the US government. These might explain some declines, but this isn't the kind of manipulation some people talk about. Despite these small dips, gold has quadrupled over the past 2 years, reaching highs near $4,400, with strong support at $3,900. Interestingly, manipulation, if it exists at all, isn't producing the results many expected. Big financial players like JP Morgan, Goldman Sachs, and Bank of America are now predicting gold could reach $5,000 in 2026. That alone should make you think, if they truly controlled prices, why are these bullish predictions now the norm? Here's the bigger picture. Central banks, institutional investors, and ETFs are driving demand. People are increasingly mistrustful of fiat currencies, and money continues to flow into gold and silver. Even if manipulation existed before, its influence today seems limited compared to the sheer weight of market forces. So, whether you're a new stacker or a seasoned investor, the takeaway is simple. Understand why prices are rising, follow the flows, and focus on real supply and demand, not just rumors. If you're following along, drop a comment below and let me know. Have you noticed the shifts in gold and silver prices lately? And make sure to hit like and subscribe so you can stay on top of all these developments as they unfold. Now that we've established the big picture, let's look closer at why gold and silver are behaving the way they are. One major factor is the influence of large banks and financial institutions. Many people assume they can control the price, but in reality, their power is far less than most believe. Even when banks like JP Morgan or Goldman Sachs attempt to influence prices, they are also subject to market forces, investor demand, and global events. The metals markets are bigger than any one player can fully manipulate. Take gold, for example. The Federal Reserve, the Treasury, and central banks all play roles, but their incentives have shifted. Central banks alone are now buying over 30% of the world's annual gold production. That's a huge number. When central banks accumulate gold, it naturally pushes prices higher, regardless of any attempts at suppression. People often forget that manipulation requires counterforces. If major institutions are acting in favor of rising prices, suppression is limited. Another factor to consider is the role of ETFs and investor demand. Exchange-traded funds provide access to gold and silver for millions of investors. When gold or silver prices rise, these instruments attract more investment, creating a positive feedback loop. This inflow of money doesn't just happen in isolation. It reflects confidence in precious metals as a hedge against currency devaluation, inflation, and financial uncertainty. Then there's the question of fiscal policy and the broader economy. Interest payments on US debt now exceed military spending, as analyst James Thorne pointed out in his recent interview. This underscores why gold and silver are so important. Governments might formally reassess assets on their balance sheets, including gold, which could indirectly push prices higher. In other words, the system itself is incentivizing higher gold values, even without a single manipulator pulling strings. We also need to consider the psychology of investors. Market participants are not just numbers on a chart. They are humans reacting to risk, news, and uncertainty. People are moving money into metals because they see instability in fiat currencies. Unlike paper markets, physical gold and silver cannot be created out of thin air. This scarcity adds real value, and the market responds naturally when demand outpaces supply. It's easy to get caught up in stories about manipulation, but the evidence suggests something else is at play. Fundamental shifts in supply, demand, and global trust in money. Silver, in particular, is under pressure from industrial demand, mining production, and technological developments. Unlike gold, industrial use creates real demand that can't be easily manipulated. Finally, consider the long-term trend. Over the past decade, we've seen a slow but steady increase in gold and silver accumulation by both institutions and private investors. This trend is being reinforced by geopolitical uncertainty, inflation fears, and government policies. Manipulation, if it exists, is a minor factor compared to these broader forces. For serious stackers, the key takeaway is to focus on fundamentals, not fear or hype. Watch central bank purchases, monitor ETF inflows, and stay informed about industrial demand for silver. These are the real drivers of market behavior. If this analysis is helping you make sense of the metals markets, hit that like button, share with fellow stackers, and keep tracking the developments with us here at Gold Rush Reporter. Knowledge is the best hedge against uncertainty. Now let's shift focus to silver specifically, because while gold is often the headline, silver is where volatility and opportunity meet. Over the past few weeks, silver has been bouncing between highs and lows, leaving many investors confused or panicked. But if you step back and analyze it as a specialist, the pattern is clear. Buy dips, hold long-term, and ignore emotional trading. Those who panic sell during minor pullbacks are the ones losing money, while true stackers see opportunity. One reason silver is so volatile is its market size. Compared to gold, silver has a much smaller market and lower liquidity. That means price swings are more extreme when demand spikes or supply tightens. Industrial demand adds another layer of complexity. Electronics, solar panels, and electric vehicles consume a significant portion of global silver production. When these industries expand, prices naturally rise. When they slow, prices can dip, but the overall trend remains upward due to scarcity. Another factor to watch is backwardation in the silver market. This occurs when spot prices exceed futures prices, signaling a tight supply. Recently, backwardation surged in major markets like COMEX and LBMA, showing that investors want physical silver now, not months later. This is a red flag for those relying on paper silver because it indicates a real shortage. True stackers understand that physical metal is what protects you from market disruptions, not digital or ETF holdings alone. Global events also play a critical role. For example, the US recently added silver to the critical minerals list, which could lead to tariffs or restricted imports. China's restrictions on silver exports further reduce available supply. Meanwhile, India's move to peg silver to gold at a 10.1 ratio could increase its role as real money. These geopolitical and policy factors create long-term upward pressure, making short-term dips ideal buying opportunities. Let's not forget investor psychology. When silver hit highs of $54 recently, many panicked at pullbacks to $50, thinking they missed the peak. But historical patterns show similar cycles. Prices dip, investors panic, then silver recovers and moves higher. True stackers profit from this, buying low and ignoring the emotional noise. Emotional trading is exactly what keeps prices suppressed temporarily, but only temporarily. Another key point: while gold is often a safe haven, silver is more sensitive to market swings. A 10% move in gold often translates to a 15% move in silver. This magnifies both risk and reward. Traders may see this as volatility, but stackers see it as opportunity. The market is teaching a clear lesson. Physical metal holds intrinsic value, and timing your accumulation during dips maximizes long-term gains. Finally, consider long-term fundamentals. Silver's average production is limited compared to industrial and investment demand. Any sudden spike in demand or supply disruption creates rapid price movement. Those who anticipate these structural deficits and act accordingly position themselves ahead of the curve. For viewers of Gold Rush Reporter, the takeaway is simple. Focus on long-term accumulation, ignore short-term panic, and watch market fundamentals closely. Supply, demand, and geopolitical factors drive real value, not speculation, not hype. By understanding these dynamics, you can stay ahead of casual investors and protect your wealth effectively. If this part of the analysis makes sense, share it with fellow stackers, hit like, and stay subscribed for continuing updates on silver and gold trends. Now, let's examine the bigger picture in precious metals, particularly how silver and gold interact with broader markets. While silver reacts more violently to short-term changes, gold remains the anchor. However, both are now influenced by structural forces rather than manipulation rumors alone. Central banks, institutional investors, and ETFs are pouring money into these metals, which creates a feedback loop that reinforces rising prices. When inflows increase, the market naturally tightens, leaving less metal available for immediate purchase. Silver's industrial demand intensifies this trend. Sectors like solar, electronics, and EV manufacturing are growing rapidly, meaning more silver is being consumed than mined. This ongoing deficit ensures that long-term holders benefit, while traders chasing short-term gains may be shaken out. Remember, scarcity drives price, and physical ownership is the ultimate hedge. Those holding ETFs or paper silver without real delivery risk missing the actual supply squeeze, which is what makes stacking physical silver so important. Another element to consider is volatility patterns. Prices bounce between predictable support and resistance levels. Recently, silver hovered around $50 to $54, echoing previous cycles. Panic selling at dips, followed by a recovery to previous highs, repeats itself because many investors react emotionally rather than rationally. Understanding these cycles allows you to buy the dips strategically. For true stackers, this is not fear, it's opportunity. Geopolitical developments are also adding pressure. US restrictions, China's export controls, and India pegging silver to gold all signal tighter global supply. Governments are increasingly recognizing silver as critical, which could result in tariffs, limited availability, or other regulatory constraints. This creates a strategic imperative for investors. Accumulate physical silver now before the broader market catches on. The timing advantage belongs to those who understand the fundamentals rather than those chasing headlines. Psychology remains a key driver. The desensitization effect is in full swing. Prices that once seemed high, like $50 or $54, now feel normal to newer investors. Long-term stackers, however, maintain perspective, knowing these prices are historically elevated. This disconnect between perception and reality allows informed investors to purchase at relative bargains during temporary pullbacks. Emotional selling, on the other hand, guarantees missed opportunity. Finally, it's worth noting the correlation between silver, gold, and other commodities like platinum, palladium, and copper. A shift in one often ripples across others. Shortages or structural deficits in silver often signal pressure on other metals, highlighting the interconnectedness of commodities. For investors, watching these correlations can help anticipate market movements and make better informed decisions. For followers of Gold Rush Reporter, the lesson is clear. Avoid emotional trading, focus on physical accumulation, and pay attention to macroeconomic trends and structural deficits. Silver and gold are not just investments. They are insurance against currency devaluation, market shocks, and systemic instability. If this insight resonates, share it with your fellow stackers, like the video, and subscribe to continue receiving clear, expert analysis on precious metals and market trends. Stay vigilant, stay informed, and always think long-term when it comes to physical assets. As we wrap up this series, let's summarize what's happening in the silver and gold markets and why it matters to you as an investor. Silver may be volatile, but its fundamentals have never been stronger. Structural deficits, industrial demand, geopolitical factors, and central bank activity all point toward a long-term bullish trend. Emotional reactions, panic selling, and short-term speculation only create noise. Real wealth comes from understanding the market and acting strategically. Right now, silver sits at historically high prices relative to past decades, even with temporary dips. This is an opportunity, not a warning. The buy low, sell high principle is simple, yet many fail to follow it due to fear or impatience. Real stackers know that each dip is a chance to accumulate more metal at a relative discount, lowering the average cost per ounce and preparing for the inevitable upside. Those chasing moment-to-moment price swings will likely miss the long-term gains entirely. Gold continues to act as a stabilizer. While silver may be the more volatile and leveraged asset, gold provides consistency and security. Central banks, hedge funds, and institutional investors are pouring into these metals, creating inflows that reinforce upward momentum. The combination of physical scarcity, rising demand, and financial uncertainty ensures that both metals will continue to gain value over time. It's also critical to understand the psychological component. Market participants often misjudge prices because of recent highs or lows, creating cycles of panic and euphoria. For informed investors, these cycles are predictable and exploitable. Patience and rational decision-making are what separate successful stackers from those who chase trends and lose. This is why physical accumulation is key. It's insurance against manipulation, market noise, and fiat currency devaluation. At Gold Rush Reporter, my mission is to cut through the confusion and give you actionable insights. I analyze the metals markets as they actually are, not how the headlines portray them. You now understand why silver's temporary pullbacks are normal, why $50 or $54 is historically significant, and why long-term accumulation is essential. By keeping a clear perspective and focusing on fundamentals, you position yourself for real gains while others react emotionally. Before you go, remember to subscribe to Gold Rush Reporter, hit the bell for notifications, and share this information with fellow investors who want to stay informed. Engage in the comments with your thoughts and questions. I read them all and often highlight the best ones in future videos. Your participation helps build a stronger, smarter stacker community. Finally, stay prepared. Continue to accumulate physical silver and gold, track global developments, and focus on rational strategies rather than market hype. Precious metals are more than investments. They are protection against financial uncertainty and a hedge for the future. Thank you for tuning in to Gold Rush Reporter. I appreciate your time, your attention, and your commitment to understanding the true value of gold and silver. Stay vigilant, stack wisely, and I'll see you in the next video with more analysis, updates, and insights from the front lines of the precious metals markets.